Hello, everyone. Welcome to today's distinguished speaker series hosted by Asian Institute of Corporate Governance at Korea University Business School. My name is Junho Hwang, a professor here at Korea University Business School, and I am honored to be your moderator today. Our topic today is misconceptions and realities of stock market short-termism. It's widely believed that stock market pressures compel managers to prioritize immediate returns, thus limiting critical long-term investments such as research and development. However, some scholars have begun challenging this conventional wisdom, suggesting that the perception of short-termism may overlook deeper structural issues such as technological advancements, policy uncertainty, and job insecurity. This discussion seems very relevant in Korea, where increasing demands from activist shareholders for short-term gains have sparked debate about corporate governance and long-term investment strategies. To shed light on this complex issue, we are privileged to have an esteemed expert, and it is my pleasure to introduce our keynote speaker, Professor Mark Rowe. Professor Rowe is David Berg Professor of Law at Harvard Law School, specializing in corporate law, governance, and political economy. He is widely recognized for his influential scholarship, notably his book titled Missing the Target: Why Stock Market Short-Termism is Not the Problem. His research has appeared prominently in top academic journals and many media outlets such as Financial Times and the Wall Street Journal. Professor Rowe is also a distinguished member of the American Academy of Arts and Sciences. So without further ado, please join me in welcoming Professor Mark Rowe for his keynote address.
Thank you very much for the introduction, and thank you all for inviting me to talk about a subject that has concerned me for a considerable period of time. And as you said, the principal thesis is the media, corporate governance, and policy making focus on short-termism in the United States. My view is overdone. It's not the serious problem that people have long made it out to be. The evidence doesn't support it. A significant portion of the things that curing short-termism are supposed to do won't cure short-termism, and there's a significant amount of interest group pushing of the argument for their own benefit. So let's go through what I think about the subject, and then you can tell me whether what else needs to be done. So let's just see if I can advance this slide. There we go. So I break down the short-termism inquiry into four major sub-issues. One, just what is it? What is stock market short-termism? What are we talking about? And for an issue that has been so prominent in the United States, it's surprising to me that it's actually not well defined. Then what does the evidence tell us about the various definitions and thinking on stock market short-termism? What's the goal in curing the stock market short-termism that's perceived to be important, and what would the costs be of curing? And then the fourth, why is there so much attention to stock market short-termism? In that, if you're with me through the first three issues and agree, you'll think it's not that big a problem. And so when the American economy has so many problems, why do we focus? Why have we tended to focus until very recently on stock market short-termism? And there, some of the explanations already alluded to in the introduction. There's some political explanations. There are some psychological explanations as to what I think is an over-attention to stock market short-termism. So I'll take a few minutes to go through each of these in a little bit more detail. So what is stock market short-termism first? According to opinion makers around the world, it's a financial problem, and the financial world's short-termism. This is from the World Economic Forum in Davos, very influential group of people. And stock market short-termism, the finance world short-termism, is so pernicious that it will destroy our communities, our economies, and the planet. The focus is that short-termism looks like it's what's doing the climate damage and global warming. So here's Klaus Schwab again on stakeholder capitalism. Schwab has been the central figure in the Davos organization. Companies do not have to stop pursuing profits for their shareholders, he says, to make the world better. They have to just become long-term in their thinking, and this will facilitate improvements in, you can see it in the title of his work, people and the planet. You're gonna, I hope you'll forgive me for not knowing as much about Korean corporate governance as I should. I read English language things, and my Korean students often try to teach me about what's happening in Korea, but I'm not going to assert certainly not expertise, but not even a satisfactory level of knowledge. In the EU, I'll make a comparison. There have been major efforts to deal with stock market short-termism, and the general thinking has been that stock markets and trading in stock markets is short-term and sustainable in climate, social structure, and the like is long-term. And therefore, to have a more sustainable European society, somehow government and the economy has to make the stock market short term. Some of it by stymieing trading because trading is short term, and at a lower level in that it's not as vivid in public discourse. This is the kind of thinking that also occurs in many Securities and Exchange filings when there are efforts to decrease the power and influence of shareholders and in particular hedge fund activists. Uh, the problem that I think is involved in this thinking, which is central to short-termism projects in Europe and the United States, and you'll be able to tell me if it's true for Korea also, is that most of the climate issues are not really time horizons issues for stockholder investing. It's an externality issue in that companies will tend to be willing to externalize costs, whether they're long-term or whether they're short-term, and manipulating the horizon of the company, as long as it's profit-focused, will have very limited, maybe even zero impact on sustainable issues like climate and social stability. So here's another ESG corporate social responsibility effort. The movement is compelling corporate leaders to reconsider the shareholder-centric model. And right there, I think they are getting the issue in that shareholder externalities will do harm to the rest of society. But then they go on to pick up our issue of the next hour or two. Is central to this movement are criticisms that companies today are too short-term oriented. And the idea that I would try to emphasize to you is the first sentence does not lead to the second sentence. Shareholder-centric models will lead to companies externalizing costs. And it doesn't make too much difference whether they're long-term or short-term oriented. It's profitable to externalize costs on the rest of society in the long run and in the short run. So the way I illustrate this with a Venn diagram is the core aspect of short-termism is the company favoring short-term profits over long term. There are great projects and investments out there that will return billions of dollars in 5 years, but won't return anything in the next year or two. Is there something in the mechanisms of the stock market that systematically, strongly, and perniciously favors the immediate profit over the long-term profit inordinately? I mean, profits 5 years from now are not as valuable as profits today from a present value perspective. And the corporate short-termism perspective here would be that the immediate profits are favored much more than a discounted present value calculation should lead to. Uh, but a significant portion of the short-term thinking and activism is really focused on social short-termism. Society is not dealing well enough with climate change, and companies will favor corporate profits over long-term social value. In particular, they'll favor short-term corporate profits over long-term social value. Um, these probably intersect, but for the most part, they're different in that the shareholder primacy defects on the right mean that companies will tend to favor their profits over society's well-being. And they'll do this in the short term, and they'll do this in the long term. And making companies more long-term, but still have incentives to favor shareholders will not be a cure for the externality problem. Yet the externality problem suffuses the short-termist debate, at least in the United States and in the EU. So some examples of things that could be short term. Failing to invest because the profits don't come fast enough. And the idea would be even on a net present value calculation, the profits 5 years from now are so good we should invest. But because the company can't think beyond the next quarter, it fails to make that investment. That is core corporate short-termism, if it exists, in significant part. Declining research and development is in the United States has frequently been blamed on corporate short-termism. Investing in R&D has a payoff 3, 5, 10 years from now, and costs something in profits today. Again, if companies are not doing an appropriate amount of R&D, then this is core corporate short-termism. And the third, which has disappeared in media popularity in 2025, but was central in media focus on corporate short-termism for about 10 or 12 years. Companies are doing too many buybacks. They're buying back so much stock that cash is disappearing from the corporation so that the corporation is killing itself by decapitalizing. So those three things, if true, and in a moment or two, I'm going to argue that the evidence indicates that they're somewhere between false and not very important. Those three things could be core corporate short-termism. But a significant part of the debate is on the right-hand side, which, as I've said, is not true time horizon, damaging the environment and the planet. I've already mentioned this. This is a problem in the short run, and it's a problem in the long run. And it develops from companies profiting by externalizing costs on the rest of society. Mistreating stakeholders. If it's true that the corporation mistreats stakeholders for the purpose of generating more profits, then this is a social problem. But it's not so clear that it's a time horizon problem. So if the company mistreats stakeholders today, tomorrow, and next year, this is a potential serious social problem, but it's not necessarily a time horizon problem. It could be. There is some intersection there in the middle. But for the most part, it's companies pursuing profits at the expense of others. And this was particularly a focus in the few years after the financial crisis of 2009. And the idea was that banks were taking too many financial risks to generate short-term profit for the bank, and thereby exposing the American economy and really the world economy to significant damage. So just to repeat, as I say, the things on the left I see as true time horizon problems. The things on the right are mostly externalities with a very limited time horizon impact, but a significant portion of the reform agenda in the United States and the EU, at least until recently, with the election of Trump, the focus of a lot of things has shifted. But until very recently, and maybe soon again, the focus for short-termism in the EU and the United States has often been on what are really social problems and not time horizon problems. So everything is seen as stock market driven short-termism when only a portion of these problems are stock market driven short-termism. So just an illustration, ExxonMobil, very big oil company, and climate change activists say the reason ExxonMobil pollutes so much in generating so much hydrocarbons and putting so much carbon into the atmosphere is that their short-term stock market value dominates their thinking. And I think that view is half right and half wrong. It's stock market value that dominates, but not short-term thinking that dominates. ExxonMobil is actually quite a long-run organization. There are units in ExxonMobil that are trying to game out what the market for gasoline and oil products will look like in the 2030s, the 2040s, and the 2050s. Will we be driving Hyundai electric cars, or will we be driving gasoline-powered cars? Are there other things that are going to substitute for hydrocarbons? They're thinking about where the world is going to be 20, 30 years from now. The real issue is that ExxonMobil profits by selling jet fuel to airline companies, and the rest of society pays the cost of climate change and global warming. I'll just mention this. So this is part 4. There is a corporate governance intersection which has been important in the United States, and you'll be able to say whether it's important in Korea also. People who are defending management in the United States in corporate governance disputes, and the disputes include litigation for a transaction and rulemaking at the Securities and Exchange Commission, frequently say if more authority is given to management and less is given to shareholders, management will be able to do more to bring climate change and global warming under control. Therefore, stymie the activists and keep shareholders away from corporate governance institutions. And it's not just that we'll have a better run company, in the opinion of management. It's also that it'll be good for the planet to do this. So, conclusion for part 1. What is stock market short-termism? My view is that people have conflated two things. One is doing things that are profitable immediately, but could be more profitable if the firm had a 3, 5, 10-year horizon. Failing to invest, failing to do profitable in expectation, research and development. That's one view of short-termism. A second view of short-termism is that the stock market's short-termism, not its selfishness, but its short-termism, is leading to more social problems, the most prominent of which has been climate change and global warming, but also mistreatment of employees, stakeholders, and the like. And my view on this for part one is keep the two separate. The first is analytically real. Let's look at the evidence to see how important it is. The second is, for the most part, analytically incorrect. It's not a time horizon problem. That's the principal issue in externalities. So, part two. What does the evidence tell us about stock market short-termism? That really requires more than the 5 or 6 minutes that I'm going to give it, that we have to give it here. It requires going through each piece of evidence carefully, which I like to think I did in getting ready to write and publish this book. But we can summarize it. And there are two levels of evidence to think about. One, is there evidence that firms are short-term in the present value sense? And the second is there evidence that the entire American economy is consequently short-term in the first sense of favoring immediate profits over longer term profits? The two get conflated, but they're actually quite different. Firms could be short-term, and the whole economy could be operating just fine. And the basic explanation, this is telegraphing what's going to come, is if my company is too short-term, that gives an opportunity to your company to invest in what I'm failing to invest in. And as long as you pretty much cover what I failed to cover, the entire economy is okay, even if my firm is not okay. So, I guess I just said what's on this slide. So true time horizons, as I'm seeing it, is stock buybacks that are killing the company as opposed to doing something else. A declining investment that's really profitable from a discounted present value problem perspective. And then the third, I call it here partial equilibrium problem using the economist vocabulary. But the basic idea is even if public companies fail to invest, if private companies, private equity makes the investment, we're okay as a society. And if some public companies fail to make the good investments from number two here, but other public companies in a competitive environment pick it up, we're again okay from an economy-wide perspective. So some of the evidence. The evidence is important because I don't want to deify the American political system and the American Congress as carefully distilling what the best academic thinking is. General public opinion is going to be much more important. But for some members of Congress and for some people who influence Congress, the good academic research, when distilled, could influence a few. And that was kind of my goal in doing this part of the article. And I think we can just look at a couple of the major studies. Well, one, I should say, the academic opinion on whether this kind of what I'm calling core short-termism is real in many firms is divided. Half of the studies are saying we're looking where it should be and we're not finding it. And half of the studies, we're looking at where it could be and we're finding it. There are a couple of studies that are quite prominent, and so I'll briefly discuss each one of them. Graham Harvey and Rajgopal have a well-known study. It's for most academics who don't get paid attention to by the financial or other media. It's a dream as a career item in the 2000 media citations to Graham Harvey and Raj Gopal's article. Most academic work is not paid attention to at all by media. I read the attention as being that the media people have found something that's straightforward to understand and fits their perspective of how the financial world works. So the general idea of the article is they surveyed chief financial officers of public firms and asked, would you sacrifice value to avoid earnings volatility? 78% of them said they would. And I long considered this a substantially convincing piece of work. If most chief financial officers say we would sacrifice value to avoid volatility, um, the first reaction is to take them at their word that that's what they would do. It's in some ways a negative admission of the chief financial officers. It's a negative admission because most chief financial officers don't want to think that they're short-term focused. There are a few conceptual issues or data issues in the paper that the authors who are leading financial economists in the United States that they recognize. One is there's a 10% return rate from their polling. Um, um, that's actually high for a poll like this. Most CFOs get a letter or an email from an academic, and it's one of the first things to delete. So a 10% return rate is pretty good for this kind of a study. But as the authors recognize, there could be a selection effect. Maybe the 10% who are most worried about short-termism are the ones who respond. And most of the other 90% who don't think short-termism is a problem just click and delete, as this is the same thing as a phishing email or something else. Secondly, and this is actually, I think, fairly important, executives who are responding think they're sacrificing long-term profits, but possibly not. So if there is a potential to invest in a factory that will not produce long-term profits, and the CFO and senior management get some pushback from shareholders, the executives who decline to make the investment may think we're sacrificing long-term profits and answer this survey positively. But it's at least possible, logically, and I suspect true some portion of the time, that the shareholders that are pushing back are saying, we don't think you can make money on this factory over 5 years. It's a declining business. It's a declining market segment. Don't put more money into this business. In the book, I give a few that may be a little bit better than anecdotes, but they're kind of anecdotes of paper industry companies that didn't make investments, but they didn't make the investments because paper products were in decline in the United States. We communicate via email and sending PDF files instead of by paper nowadays. Well, last thing is 78% said we would sacrifice profits if it was important to avoid earnings volatility. The way it's been reported in the media, because I think this resonates with media view, 78% would, and the implication is are. But what the CFOs were saying were not uniformly, we are sacrificing value now to avoid earnings volatility. They're saying if we had to, we would. But many of them were, things are fine, we have good enough earnings stability, we don't have to sacrifice. I'm going to skip the last bullet point because we've covered it conceptually. There's another significant issue with this piece of research in concluding that 78% would sacrifice, and we've got a big problem. What the authors did is they aggregated those who would say we'll do a small sacrifice, about 50%, those who said we'd do a moderate sacrifice, about a quarter, and the sliver who said they'd do a large sacrifice. So arithmetically, it's perfectly correct. 78% said they would sacrifice. But look at that second bar. It's the second bar that's dominant. It's small sacrifice. And even with all the conceptual data issues, the alternative way to aggregate their data could be something that doesn't resonate with the media, but could be only 25% of those polled said that they would make even a moderate sacrifice. You could aggregate the small sacrifice, which I read as it's not really a big problem, with the no sacrifice, and come up with about 3/4 of the respondents saying we would not do anything significant to damage this company, even to maintain earnings stability. I've already said this. So the general thinking, before I get to COVID, the general aspect here is half of the studies do say we get some firms displaying stock market short-termism. Half of them, when they look, say we can't find it for hedge fund activism and the like. Here's one that to me communicates well. COVID. When COVID hit in the United States, the projected decrease in earnings was tremendous. By the second quarter of 2020, the average projection was that earnings in the United States would decline by nearly 50% that quarter. They went a little bit too far in that earnings did decline as expected, and by a lot, but it was by about 30%. But look at the change in the Standard & Poor's 500 index. There was a decline in the first quarter of COVID. In the second quarter of COVID, while earnings were declining even more, there was essentially a full recovery of the stock market. And it was clear what was going on. The stock market had concluded, and this in some ways is medically gruesome, as nearly 1 million people did die in the United States of COVID. The stock market was saying, this is really bad for 2020, and it may be really bad for 2021, our short term, but it's not going to cripple the economy long term. So the Standard & Poor's index actually rose over the course of the first year of COVID. Economic activity declined, earnings declined, unemployment skyrocketed, highest unemployment in the United States by some measures since the Great Depression. But nevertheless, the stock market was not focused on the short term. They were focused on, we will get through this, and when we get through this, there will be gruesome economic and medical costs, but it will not destroy the economy, as a negative 44% earnings decline would indicate. So the conclusion from part 2 is, I don't think we should assume from the evidence that we've really got a severe case of stock market short-termism. The evidence is divided, and several of the stronger studies actually point to modest levels of stock market short-termism, not the crippling levels that they're sometimes interpreted as indicating. I'm gonna skip that. So the third, cures and their costs. Many of the proposed cures for stock market short-termism aim to siphon off shareholder power. Many of the cures seek to dampen trading. Many of the cures look to have companies report their financial results less frequently. And well, uh, each one of these has costs and weaknesses. So the first, it's not so clear that boards of directors are more long-term oriented than the stock market. Um, Not enough time to go into it here, but there are some reasons to think that the stock market may be more long-term than boards of directors and executives with a short time horizon for their tenure and a compensation system that compensates them for relatively immediate profits. Um, Dampening trading, same thing. It's not clear that dampening trading will cure what seemed to be stock market short-termism, and that dampening trading doesn't mean that there won't be trading. So to the extent that executives pay attention to stock price, there's still going to be a changing stock price, even if trading is dampened. And it's even possible that it could make it worse because with less trading, the stock price is more likely to lurch from one number to another. Less frequent reporting is also an odd cure in that to the extent there's serious analytic work saying that stock markets are more short-term than they ought to be, the best work in this area looks at the information flow to the stock market and shareholders. And the argument is the shareholders with weaker information, less dense information, will tend to focus on just simple signals of profits. So if there's less frequent reporting, but they're still reporting, there's a good chance that the stock market will end up less informed and be less able to measure the long term than they would otherwise be. And kind of the debater's point that I've made in a Wall Street Journal op-ed on the issue, all of the frequent reporting thinking is let's stop mandatory quarterly reporting and let's go to semi-annual reporting. And the quip that I've made is the 6 month reporting, 6 months is not long term. Going from 3 months to 6 months is not going to deal with 5-year investments if 5-year investments are a serious problem. So the last one, why is there so much attention to short-termism? So if you're with me on the first three aspects, we've got a category problem in lots of things that are seen as stock market short-termism. Externalities are not really time horizon problems. The evidence in favor of there being deep stock market short-termism is weak, and maybe the evidence points in the other way. It's divided, but I think the best evidence points away from there being deep stock market short-termism. The proffered cures seem to be as costly as their potential for helping whatever residual problem there is. And then the next question, which is maybe speculative, is why do we pay so much attention to it in the United States, at least until the last presidential election? And there are a few explanations. One is there are interests who profit from paying attention to it, like mainly executives and boards. Frequently, employees and critics of the large corporation want to point out its defects. Their psychology, long-term in ordinary discourse is good, and short-term in ordinary discourse is bad. So from a financial perspective, long-term, short-term is not particularly good or bad. It's which makes more profits. But to call me long-term oriented is to compliment me. To call me short-term oriented is to disregard, to dismiss whatever good qualities I have. And then it becomes easy. Traders are short term, and they are, and so therefore they're bad. Interests. Corporate discourse in the United States for really about a half a century has had as a significant element efforts to empower managers over shareholders and over shareholder activists. In the 1980s, when hostile takeovers was the central corporate governance issue, here's an example. 50 years ago, Marty Lipton, if you haven't seen this, has been over the decades the principal spokesperson for managers and boards in corporate America. He's very insightful and he's very effective as an advocate. And here is one of his effective pieces of advocacy in a well-read business lawyer article. He concludes that the central policy issue for hostile takeovers is whether the long-term interests of the economy should be jeopardized in order to benefit speculators interested in only a quick short-term profit. And he's been selling that idea for decades. So this is 1979, 2023 vis-a-vis hedge fund activism. The purpose of the corporation is not to maximize short-term profits, but to operate in the interest of all stakeholders to promote long-term value of the corporation. It's been a very effective rhetorical move when the evidence is much more mixed. So here also, Joe Biden, who was president of the United States for 4 years, wrote in a Wall Street Journal editorial, "Short-termism saps the economy." And he explained his view of how it saps the economy. The big forces of stock market short-termism have flattened working class wages. The working class, at least, used to be a core constituency for Democrats. Wall Street forces business leaders to focus obsessively on the short term to the detriment of the working class. So now we have two interest groups, employees, Biden, and management, Lipton, who have an interest in promoting the short-termism idea. It continued during the first Trump administration. As I said, Trump administration has been focused on other things, but even during the Trump first administration, Trump asked the SEC to investigate short-termism. The SEC had a symposium on stock market short-termism. I participated in it. I'd like to congratulate myself in convincing a few people that it's not that big a problem, but I suspect they just didn't do anything, not because of anything I said, but because they had other issues on their agenda. They didn't follow up. So it does matter in terms of which narratives are important because the narratives affect policymakers. They clearly affect policymakers in Congress who are not corporate experts, but they also affect policymakers among the direct corporate governance people. The short-term is in play when the Securities and Exchange Commission makes rules on how powerful shareholders will be or not be in the corporation. It affects Delaware judges, where most American day-to-day corporate law is made. It makes it easier for the Delaware judge to psychologically keep hedge funds at bay because Marty Lipton has somewhat convinced them that doing so helps the American economy overall, and it's not just a doctrinal issue of how to interpret this aspect of the corporate statute. So it's used by interests, I think, in the United States to push not so good solutions to corporate issues. It should be dropped from the debate. So that's it. 4 issues. What is stock market short-termism? I've argued to you that it conflates things that are not really stock market short-termism, externalities, climate change. The evidence overall is not propitious to stock market short-termism being ridiculously pernicious in the United States. One, on the firm level, it's divided. I think some of the strongest studies showing stock market short-termism show less stock market short-termism than they seem to. And then on the macro level, once some firms do really become stock market short-termists, that provides a profit incentive for other firms to pick up the investments or the R&D that the short-term firms have lost. So even if some firms are short-term, that doesn't mean that the economy is overwhelmingly short-term. Most of the cures that have been advanced, I think, don't do much for stock market short-termism, and they're costly. Why is there so much attention if you believe in the first three things? Well, there's a lot of attention because a lot of the interests and media don't believe in the first three things that I put in front of you. But they also get a boost from politics. There are interests who benefit from the stock market being seen as short-termist. And the psychology of the words is beneficial to a boost to stock market short-term. Short-term looks bad. Long-term is good. But from a finance perspective, bad long-term investments that waste money are bad. Good short-term investments that don't have a long-term market place are good. So that's the end. I thank you. I thank the Institute of Corporate Governance, and I'm looking forward to what you all have to say on the subject.
Thank you. Thank you very much, Professor Rowe, for your insightful presentation. We appreciate you challenging the conventional wisdom on stock market short-termism. I think your argument that many issues blamed on short-termism are maybe better understood as problems of externalities versus time horizon problem provides a critical framework for our discussion. And now, I'd like to introduce the panelists who will engage in discussion with Professor Rowe. In alphabetical order, we have Ji-Woong Chung, Professor of Finance at Korea University Business School. We also have Hyung-Kyun Kim, Executive Director at Chop Partners. We have Woo-Chan Kim, Professor of Finance at Korea University Business School and the Executive Director of Asian Institute of Corporate Governance. And we have Namu Lee, Chairman of Korea Corporate Governance Forum. The format for our discussion will be as follows. Each panelist will ask a question, and Professor Rowe will respond to each question for about 3 to 5 minutes. We plan to conduct 2 rounds of questions in this manner, and I hope to see a dynamic exchange of ideas. With that, let's begin our panel discussion. I'd like to invite our first panelist, Professor Ji-Woong Chung, to pose question to Professor Rowe.
Oh, hi, I'm Ji-Woong. Before I begin my prepared question, I have just a short comment on one of the studies that you cited, Graham, Harvey, and Razgopal. So while listening to your talk, it occurred to me that the manager's attempt to reduce this earnings volatility is not purely driven by short-term motives, I think, because reducing this earnings volatility could be good for long run, because for example, it could reduce long run cost of capital, which will enable companies to take more positive NPV projects and increase firm value. Okay, yeah, I just wanted to make a quick comment on that. So I had a chance to review the questions prepared by our panel members today, and it occurred to me, at least to me, it is clear that we all share a common understanding and view on the key issues about Korea's capital markets and corporate governance. So some of the questions that are prepared are pretty similar, I think. So anyway, so as the first discussant of the panel, entirely at my discretion, I'll begin by trying to give you a very short background to set the stage for further discussion. So in Korea, many controlling shareholders in Jaebol, family-run conglomerates, they often argue that they need to protect their companies from short-term oriented outside investors. So they frequently label foreign shareholders and activist funds as speculative investors driven by short-term motives. Okay? Also, they argue that they have a long-term vision for the company's future, so protecting their managers and themselves from outside interference is better for long-term value. Okay? However, we have seen many cases of serious conflicts of interest between controlling and minority shareholders in Korea. So it's very common for controlling families to engage in self-dealing transactions or restructuring strategies that benefit themselves at the expense of other and outside minority investors. And this has been contributed to the what's called the Korea discount. So in response, policymakers have tried to seek some legal reforms to limit this kind of abusive practices. So for example, today, just about an hour ago, the National Assembly passed a revision to the Commercial Act to expand directors' fiduciary duty from just the company to also include the interest of all shareholders. Okay? So what the idea is very simple. The idea is to better protect minority shareholders and discourage controlling shareholders from pursuing family interest over the company's or shareholders' welfare. So controlling shareholders here in Korea, they are, possibly, or the media outlets as well, possibly missing the target by blaming outside investors' supposed short-termism, okay? When the real issue might be internal governance or controlling shareholder opportunism. Okay? So my first question is that about this newly passed law. Do you think that the extending fiduciary duties to protect shareholders alongside the company, okay, whether it's a wide approach to encourage better long-term value for the companies, whether it could create some unintended consequences, such as excessive litigation, okay? And also more broadly, what types of governance reforms do you think are more appropriate or more constructive in markets like Korea?
Okay, this is a good question. Fiduciary duty. Most American corporate law academics, if they were sitting in my seat, would extol fiduciary duties and its capacity to handle problems inside the corporation. I'm in a minority view of that, and that my sense is fiduciary duties help, but they're not as strong, as important as we tend to think they are as corporate governance and corporate law people. In that it's frequently the penalty on somebody breaching the fiduciary duty is small enough that it doesn't figure into their incentives as to whether to breach the fiduciary duty or not breach the fiduciary duty. And people have found lots of ways around aspects of the fiduciary duty environment. You probably know for a significant number of transactions where the controller, this might be very relevant to Korea, the controller is moving value to the controller's own pocket. There's a buyout or the public company is being taken private. There's a very big and detailed governance structure on an independent committee and what the level of independence is that's necessary to produce a cleansing of whatever the self-interested transaction is. Every once in a while, the committee or the judicial review of the committee, in Elon Musk's case, this was true. Every once in a while, the committee stops a transaction or changes the consideration in the transaction. But for the most part, the people who end up on the independent committee are somewhat independent, but they're not put there because they're radical critics of the incumbents in the company. They're people who don't have deep financial ties, but are likely to be sympathetic. So my sense of it is that fiduciary duties do confine, but they are not really a perfect or even a good cure for the problems that are in play. If we're talking about stock market short-termism and not interested party transactions, I do have a little bit of a recommendation, although the recommendation depends on my not knowing enough about Korean business structures. So for the short-termism possibility, if we think that the chaebol and the controlling shareholders are just too short-term oriented, the most significant fix that one could look for, I think, is different levels and different kinds of business. So more private equity, if there's not enough. More startups that end up doing the research and development that we think the chaebols aren't doing, if we think that they're too short-term oriented. And here, I'm not focusing on pulling money out from the minority stockholders. I'm focusing on the possibility that the chaebol itself is or the controlling shareholder is too short-term oriented. You know, the basic incentives for the controlling shareholder are potentially long-term oriented, in that the controlling shareholder is going to be there over the long term. There would need to be some defect that leads to the controlling shareholder not being long-term oriented. It's easy to imagine that there could be. One possibility is the long-term shareholder gets value out of running the company apart from the value of the company. So once people are mega rich, as many of the controlling shareholders already are, their value and satisfaction out of life could come from making another $100 million. But if they already have several $100 million, the odds that they're going to live better is small. But they get a lot, or at least many people get a lot from the prestige, power, there being people that are taken seriously and have to be dealt with in society. And they might want to remain in control. And here's where the short-termism could come in, even though they are not up to date with what needs to be done. They don't understand how artificial intelligence works and what might happen. So that would be the main reason why shareholders who are dominant shareholders, even though they have significant incentives to be long-term, aren't long-term, because they like the prestige and power from running the organization. Or the very point you were making, they get value, they siphon off value from the enterprise. And to siphon off value from the enterprise, that means that the minority stockholders' stock is undervalued compared to their pro rata portion of the value of the enterprise, and it means the company can't access capital markets as readily as it could otherwise. I should either preface or end this from just a gut sense of what's happening in Korea. My sense of Korea is that overall, it doesn't seem short-term focused. That is a society that's producing competitive electric vehicles. I saw one at the Hyundai dealer just before leaving on this trip, and it's either the Hyundai EV or the BMW EV that we'll end up buying when we get back. And just looking at Samsung's phones that have more market share than the iPhone, it's not clear to me that Korea somehow has some deep short-term problem. But I'm extrapolating only from two products.
Okay, thank you. Next will be Director Kim from Chop Partners.
Hi, thanks a lot for your insight, Professor Lo. I'm HK from Chop Partners Asset Management. I manage activist hedge funds here in Korea. In every activist campaign that I did, I faced criticism from not just from controlling shareholders or the corporate board, but also from some kind of ESG related institutions saying that we are short-term investors looking for quick profits at the expense of the ESG values. Your point that ESG concerns are often not short-termism issues, but rather externalities problems really helps in responding to those criticisms. So thank you. I also frequently hear from controlling shareholders that they represent long-term vision, while I'm accused of short-termist. But if you look at the reality, the story is different, I think. The total shareholder return of the Kospi index, which is a Korean market index, has significantly underperformed global indices over the past decades. If these controlling shareholders were truly long-term value creators, the data should look very different. So in my view, the short-termism label is often used as a tool to avoid board accountability and protect entrenched control. Do you agree with that? And in your view, how can we meaningfully distinguish genuine long-term value creator or visionary leadership from managers who simply claim to be long-term oriented while doing little to create real value? That's my question.
On the last one, this is very hard. In the United States, there have been several finance studies looking at the returns from hedge fund activism. The best done are Alon Brav and several co-authors, and they regularly find that the hedge fund activism creates value for the stockholders over some, not just 6 months, but permanent increase in value. Now, Korea is not the United States, so transferring the study to the Korean situation might get some pushback, but those studies are strong studies, and there's no obvious reason to me why they wouldn't apply to the Korean situation as well. I mean, most hedge funds, I suspect your hedge fund too, are looking to make money, and you're generally not going to make money by destroying value in the target corporation. So just as a beginning, the motivation, the incentives are to make money. Even on the most superficial but direct short-termist allegation has never made sense to me, which is, my hedge fund is going to buy into the company, do this or that, and then sell 6 months later. At a superficial level, maybe it has some appeal. But if I'm selling 6 months later, somebody is buying it from me. And either the buyer has to be misinformed that during those 6 months, I've taken a sledgehammer to the company and wrecked it, but somehow it has a prettier view so that the 6-month buyer will pay more than I paid for it 6 months ago. But it's kind of odd that there would be so many people fooled, at least in the United States, so often that the hedge fund can come in, take a wrecking ball to the company, and then sell the interest 6 months, 9 months later and make a profit. At some point, the buyers should have figured this out. And the fact that they're paying a premium, the best hypothesis, even without data, is that they're paying a premium because they think the hedge fund has done something to increase the value of the company during the period that I'm going to own the company, starting 9 months after the hedge fund intervention and moving forward. So that's my sense that the basic argument doesn't seem very convincing to me, although it seems to convince a lot of people. So maybe I'm wrong about it. On Korean stock market doing poorly compared to other indices over time, that does seem to be a telling issue. I can't think of anything really convincing as an alternative hypothesis to minority stockholders have been doing poorly in the Korean market, and that has kept their value down compared to other worldwide indices. One possibility, but this is just a guess, is more international competition. So if a lot of Korean sales in the international market are face competition from China, and if China's competition has become more intense over the last 25 years, maybe that could lower the profitability of the Korean companies. But that should also and has lowered the profitability of manufacturing companies in Europe and the United States. So it's at best only a partial explanation.
Okay, thank you. Next is Professor Woo-Chan Kim.
Thank you for your presentation. So my question will slightly overlap with Hyung-Gyun's. We just discussed that hedge fund activism has emerged in Korea as well. And against this, the corporate managers has been criticizing them as short-term, speculative, and hit-and-run investors. But the proponents has been arguing that hedge fund activism not only enhances the operational efficiency of the target firms, but also increases the efficiency of capital allocation within the economy. So, for example, so there's a hedge fund activist. If the target firm has been accumulating too much cash but does not have enough good investment opportunities, they ask for dividends or stock repurchases. But when it is repurchased and the cash flows out of the company, that same amount of money will flow back into the system, being invested in more profitable projects in other companies and so on. So in my view, and also the proponent's view, is that in the US, hedge fund activism has actually helped to enhance capital allocation within the US economy, which made the productivity of capital much higher, which made the U.S. to be a growing economy, even though it's a very mature country. But that is something that has not been, taking place in Korea, which I think, in my view, has dampened the share prices here. One of the reasons of Korea discount. So my question is, as the proponents have been arguing here in Korea, in the US, in your view, how effective do you think hedge fund activism were in enhancing capital reallocation within the economy, within the US economy? That's my question.
That's a good question too. My sense is that it's been an effective pressure on large firms. So large firm management has an incentive to retain cash in that it gives them a buffer against problems, If they like running a bigger enterprise, which is usually the case, they can overinvest the cash inside their business. And there's a lot of thinking and evidence that hedge funds have been a significant element in pushing cash out of large firms that have accumulated more cash than they can invest profitably. I looked at one thing that's related, and it doesn't prove the hedge fund case, but it's consistent with there's a net outflow of cash from the larger companies, and there's an inflow to smaller companies. Now, it could be that the larger companies have great investments and the cash is disappearing, and it could be that the small companies have no good investments, but somehow they're able to raise cash. But generally speaking, large firms are mature firms who are more likely to face new technologies that will displace them or change the way they have to do business. And the smaller firms are, on average, more likely to have growing companies at the technological frontier. So if you think the groups are like that, smaller are more likely to be growing and at the technological frontier, and larger are less likely to be growing and more likely to be behind the technological frontier and have managerial difficulties in getting to that frontier. That movement of cash is what you would want. So another way of looking at hedge fund activism, pushing cash out of the large firms. Once the cash comes out of the large firms, it's indirectly facilitating cash flowing into smaller firms that are more likely to be at the technological frontier. And at least one of the things that's been working well in the American economy over the last 10 or 20 years has been a good rate of technological innovation. And here, hedge funds are not the major investors in the small firms, it's venture capital. But hedge funds still play a role by pushing the money out of the large firms so that it's available to put into the smaller firms. One relevant thing maybe for Korea, and this will reveal some of my ignorance of the Korean economy. So the large firms and the family-owned chaebols are vivid. Are there a lot of things that are like Silicon Valley startups in Korea that are cash-starved? I could imagine if I were
Yes.
running one of the chaebol, I would want to starve those firms of cash.
Oh, you mean large Korean chaebols trying to starve small firms? Is that?
It's really the first issue. Are there a lot of smaller technological startups similar to American Silicon Valley?
Oh yes, they are, and they do need cash, and it would be very nice if cash-rich Korean chaebol firms would pay out dividends so that in some day it will flow back into those smaller, more innovative companies. Yes.
Okay. So there is some evidence that what you're describing as something that Korea should have does happen in the United States. We know that cash flows out, and we know that cash flows in to the smaller firms. We don't know for sure that one causes the other, but the two flows are kind of symmetrical. Every Silicon Valley company complains that they don't have enough cash. That if only they could raise another 30 million, they could get to the next technological frontier. But the facts are that Silicon Valley is pretty well financed in the United States. And some of that financing is probably, in my view, similar to your question, is due to the fact that the S&P 500 have trouble hanging on to a lot of cash for a long time.
Thank you.
Okay, thank you. Our final panelist in this first round is Chairman Lee.
Thank you, Dr. Rowe, for interesting lecture and the discussion we're having. The market's pretty smart and efficient, as you know, and the markets, pays a different valuation multiples for the companies that are short term versus the companies that are and that have been creating value over long term. And so there's a clear valuation discrepancy. And you pointed out in your book that some of the large cap tech companies in the U.S., like Amazon, they were not making a lot of money, but they were trading at a very high valuation multiple. It's a sign that investors are looking willing to pay premium, and they're looking beyond the current earnings, right? And also, we got a lot of well-run family-owned business that generate good value, earnings, cash flow over long term, and the market's willing to pay premium, right, for these businesses. I think one of the interesting debate in Korea, and I think also in the U.S., is that some of the critics of a shareholder theory claim that American companies have lost competitiveness because the board, the management have been obsessed with the short-term results. They've been spending so much money in share buyback cancellation, and they have not spent enough money in long-term investment. But there is some interesting study by Goldman Sachs going back to year 2000 for the following 20 years. If you look at the top 500 U.S. companies, they have actually increased capex investment in absolute dollar terms. And if we include the R&D, which is a very important intangible investment, American companies actually have increased their investment. So I don't agree with the critics and the notion that American companies have really become short-term and cut back on investment. So there's a clear evidence. I think the question I have for you is about the incentive for the management and the board, because these people, their behaviors are affected by how they are measured, right? So what is the best way, in your view, to create a structure to measure the management and also create a compensation system so that they become very focused and really create value over a long term consistently?
Okay, there's a lot in there. On compensation, I'm not a compensation expert, even vis-a-vis the United States, but the kinds of things that I think you'd want to see is compensation that is long-term. So can't use the stock options, can't exercise the stock options for 5 years, or bonuses tied to where the stock price is 7 years from now. And then they would have to be built with mechanisms to impede the manager from selling off the interest in stock 7 years from now. And some of it is psychology. Is just let's think about where we're going to be in 5 years. So I can't think of incentive systems other than making sure that the directors and senior management profit from where the stock price or some other indicators of the value of the company are years from now. I'd say something similar to what I was saying about Korean families. It's true that people who are making $9 million a year usually would like to make $15 million a year. But for a lot of people, they're not going to live any better, and their families aren't going to live any better physically because their compensation increases by a few million. Most still want the extra few million, but for the most part, it's making the manager take seriously the hedge fund that says there is no profit to be made in this factory. The market is going to change in the next 3 years. It's a matter of psychology of having them taking it seriously instead of dismissing it out of hand as it's a threat to my autonomy, and I really want to dismiss the legitimacy of their thinking. I won't even consider the fact that maybe this factory that we're getting ready to invest in is not likely to be a particularly profitable factory. On the first couple of comments, I have to look at that R&D study from Goldman Sachs. When I was R&D and CapEx, when I was looking at this a few years ago, what I found was something similar but not exactly the same. Is I looked at the CapEx elements of spending around the world, and what it looked like what was happening is hard asset spending was going down for the reason you allude to, is we're doing more R&D and intangibles than we're doing hard asset CapEx. So they're going down all around the world. It turned out that they were going down less in the United States than in almost all the rest of the world. Not much less, but going down less. In terms of R&D, and this resonates in current events, R&D declined in the United States on government spending. After the financial crisis, there was a very large effort, a strong effort to cut back government spending, and research and development got spending, which government financing of research and development, which was substantial and really still is substantial, has declined noticeably since 2009. And with the Trump administration's cutbacks, there's a good chance it will decline further if their cutbacks stick. Research and development generally, and in terms of welfare for people in the United States medically, National Institute of Health funding. Pharmaceutical companies spend a lot on pharmaceutical development, but a lot of research on medical care is funded by the National Institute of Health, and that could decline in the future, probably will decline in the future. Or to link this up to corporate governance, if corporate governance people in the United States, I don't know whether this carries over to Korea, are saying, look, because of stock market short-termism, we're doing less research and development. One of the answers that I want to make to them, well, where are we doing less research and development? We're doing less research and development in the United States principally by cutting back government spending. There's a lot of evidence that government spending on R&D has been very important to the American and to a lesser extent the world economies. So if you're really interested in R&D as opposed to making a position statement on whoever you're defending in the next transaction, you should be militating for building back government spending on R&D. Government spending on R&D has made many breakthroughs in the United States and has been important to American welfare.
Thank you.
Okay, thank you, Professor Rowe. So this is the end of the first round of the panel discussion. We are running a little bit behind schedule. So as we start the second round of the panel discussion, maybe the panelists could narrow down the question a little bit to the key point, maybe. And Professor Rowe, you can have, if possible, about 3 minutes to answer each question. Okay, so the second round of the panel will go in the same order as the first round. So Professor Jiung Chung, you can ask question.
Okay, so, all right, here's my question. So, I think one key insight from your book is that the stock market's short-termism is often overstated. I think this is especially true in the Korean market. So, in Korea, many firms are not really facing the pressure of the capital markets, I think. So, for example, cross-shareholding within business groups, stable ownership, and limited shareholder activism, they still dominate the market. So even though you said earlier that the Korean company seems to be making long-term investment and they're staying innovative, my sense as an insider is that there is still a very pervasive culture of short-term performance focus in Korean markets. So for example, the average tenure of a professional CEO at a Korean company is very short, 2 to 3 years on average. Okay? So of course, this will naturally incentivize executives to focus on immediate results. Okay? So even though through the official statistics, Korea seems to making lots of R&D spending and generating lots of patent outputs, many people think that they question that whether these efforts are truly reflecting long-term strategic thinking. Okay? And government and public institutions R&D programs, they often operate on annual performance evaluations. So they expect research projects to generate tangible results in a year or two. Okay? So, of course, this environment will make it very challenging to pursue a truly long-term investments. And some people trace this mindset back to historical and institutional factors. So, for example, there was the era of rapid industrialization in the 70s and 80s under authoritarian regimes. So this, some people say, that fostered a deeply rooted culture of rapid results. Okay? And also some people point to a lingering societal trauma from past political instability and corruption. So this may explain the widespread reluctance to give extended authority or autonomy to any single leader or single group. Okay? So all of this suggests that the short-termism can be a broader cultural or systemic issue, not driven purely by the stock market. By contrast, I think the United States is often seen as more supportive of a long-term investment and innovation, despite having an active and sometimes impatient stock market. So why do you think the U.S. has largely avoided this kind of short-termism in corporate cultures, unlike Korea? Okay, and why do you think? What do you think explains this difference?
I'm not sure I have a great explanation for differences between Korea and the United States, partly because I'm learning more about Korea now than I've known previously. So some of the possibilities are embedded in your question. So it sounds like Korean businesses could focus on getting results in the next short term, a year or two, partly because from mid-1950s to relatively recently, Korea was kind of catching up. So you could focus on doing something in 2 years because we kind of know what has to be done, because somebody in Europe or somebody in the United States or car companies in Europe and the United States and Japan have already done it. So we'll do it a little bit better, but we can do it fast because we kind of know what's probably going to work. And it sounds like from your question, there's embedded a potential thesis and answer, is that now that Korea's at the edge of technological development, management could still be thinking like they were thinking in 1975 is we know what to do to start building cars. We just have to do what Toyota is doing, but just do it a little bit better and a little bit cheaper and a little bit more effectively. And that thinking has to change. In terms of the 1 or 2 year horizons for research and development, that's a hard one. I mean, I think it's hard to know how much how much free scope to give to the researchers in that giving them 10 years, 5 years, maybe even 3 years could be pernicious long-termism in that it's a project that won't succeed and we're letting them go on too long with something that has a very low probability of success. And it could be appropriate for management then to say, we don't want you researchers in the research department to get lazy. We are going to insist on reviews every year. If we give you a 3-year reign, well, maybe you won't do anything until the last few months. So in some ways, it's a management issue. And I don't know whether Korea is cutting it too close or not too close. In terms of the history of political instability in Korea, this could be a difference, but it could be that we're catching up in the United States with unstable economic policies that make it difficult for businesses to invest because the Trump economic policy is so disruptive that it makes it hard for a lot of management to say, this is what the United States economy will look like in 2.5 years, so let's go here. For a lot of managers, they're thinking, we don't know what it's going to look like in 2.5 years, so we have to be very tentative of where we go going forward. That wasn't a big issue in the United States historically. It sounds like it was a big issue in Korea historically, and maybe that has made a difference. And similar to the point you were making about could demand short-term results when we kind of knew what to do. It could also be demand short-term results when we don't know exactly where the political situation will be in 2 years, and then those create a short-term management culture of some sort that is hard to overcome. Essentially, I don't have much to add to your question. I think the answers are already embedded in your question, which I think is insightful.
Okay, thank you. Next will be Director Kim.
Yes, my second question is similar to Professor Uchan's first question. So one of the most common shareholder proposals that I make during the proxy contest is to increase shareholder returns, like through buybacks and dividends. And a lot of Korean public companies have huge excess net cash. Sometimes it's more than their market caps. So I'm just frequently asking them to return their cash to their shareholders. And many times, the media and controlling shareholders blame me as a short-termist. And unfortunately, proxy advisors and other asset managers buy that argument. But what I'm trying to do is increase capital efficiency, so it's not like investment duration problem. It's like just capital efficiency issues. So in my view, do you agree that shifting the agenda from short-termism debate to capital efficiency debate is important to shift the conversation? Important to reform Korean corporate governance.
From the situation that you all have been describing, it does sound right. In terms of the political debate, I pay attention to the political debate, but in terms of framing things politically to be more successful, this is not something I'm particularly good at. In fact, I'm probably bad at it. to pick the topic that I chose for this book is suggestive of somebody who is willing to whatever run against the wind because the political view of short-termism is different from what I'm trying to sell in the book. One possibility is, my understanding is things that are vivid and concrete sell better in the political world than something that's abstract, even though it's of great importance. So capital efficiency is of great importance to us, but in the political world, it seems like an abstract idea. But if you can show 3 firms that were very promising that couldn't get financed because even though table number 1 was sitting on $300 million, these 3 promising firms couldn't get financings for even $10 million. That might have a bigger effect on political people's thinking than capital efficiency as a more important but abstract concept for them.
Okay, thank you. Next will be Professor Woo-Chan Kim.
So my second question is related to what you have said in your presentation. You said that at the macro level, if public firms have to give in their long-term investment because of the market pressure, then somebody will pick up the profitable project. For example, private firms controlled by private equity firms, and so on. My question is, in the U.S., interestingly, there has been a criticism for a long period of time that even private equity funds are short-term investors. There have been criticizing, in particular, investment strategies like dividend recap, sales leasebacks. There has been criticism against excessive management fees. And to address this concern, Senator Elizabeth Warren, the senator of Massachusetts, have introduced an act called the Stop Wall Street Looting Act, as you probably well know. And also, and she made a lot of proposals to directly regulate the industry. And Lina Khan, when she was the Fair Trade Commissioner, also have taken a legal action against like roll-up strategies, and also advocated more stringent merger review guidelines and so on. So my question is twofold. One is, do you think that private equity funds are intrinsically short-term? That's my first question. Another one is the proposals made by Elizabeth Warren. Is that really necessary, or can the problems be cured by some alternative measures?
Okay, with a 3-minute limitation. First thing I'd say, I don't view private equity people as angels or heroes any more than I think corporate management as angels or heroes. They're doing their job. In doing their job, they will frequently see opportunities and be opportunistic and take things that in a better world they're not entitled to. I also do bankruptcy things, and there are significant elements of private equity firms over leveraging their companies, and the company that ends up in bankruptcy. Sometimes, to pick up on prior comments, this may be capital efficiency. They're leveraging a company that is in a business that doesn't have a deep future, and by the leverage is a mechanism to pull the cash out. But also the private equity firms have done, not everyone in every transaction, but there have been a number of high-profile transactions where the private equity sponsor is pulling value out from the portfolio company for itself, and to the detriment of shareholders and creditors. So I don't want to turn them into heroes. But they're another competitive element in the American economy, in that there are some things that if the public company doesn't do because of the stock market, private equity firms can and sometimes will pick up. Are they long-term oriented? Their funds, the last time I looked, tend to be picked up for 5, 6, 7 years. And in terms of our ability to predict the business future, that's a long term. They tend to hold their investments for more than a few months. Usually it's measured in years. So they at least have some basic incentives to be long or medium term focused. But the point that I would want to emphasize most is they're not heroes in the sense of they're going to do everything right and that they're not subject to challenge as being too greedy. It's that they're another financing mechanism and they can pick things up when public company doesn't. For the most part, I think Warren's bill is not likely to improve the economic situation of the private equity firms. If I were going to pick things to deal with private equity and to make it more rational, I'd focus on tax in that private equity gets two huge tax benefits. One, which everybody gets, but private equity uses much more substantially, is the deductibility of interest in most countries, but in the United States, leads to us having more debt than we really deserve. And one of the things that private equity is doing is shielding some portion of the operating income from the Internal Revenue Service. And the second tax benefit that they get is the carried interest, which maybe is appropriate, maybe isn't appropriate, but most of the time looks like they're getting an extra benefit from the tax system. And so we probably get more investment in private equity than we deserve because of the use of the interest deduction and the carried interest. I should also say, outside of the question is venture capital. So even if private equity doesn't do something because their mindset isn't right, and even if the public firms aren't doing it because their incentives or mindset isn't right, or because they really are influenced by short-term stockholders, there's still a venture capital market in the United States which can pick up the new developments and sometimes does.
Okay, thank you.
Okay, thank you. The last question in today's session will be from Director Lee.
Thank you. I think some of the Korean companies and the products you mentioned earlier, whether it's Samsung's smartphone, Hyundai's electric vehicle, LG's freezers or washing machines, I mean, they're really, truly globally competitive products, and I think they reflect the long-term vision, execution, concentrated bets, and really long-term thinking behind these companies and the families behind these chaebols. But the issue is, I think they have a good story, good success, good earnings, but their balance sheets have been very inefficiently managed. A lot of them, they're pursuing a pet project, which is really something for the chairman himself and his family. I think a good example is Hyundai Motors' construction of a $20 billion headquarters at the heart of Seoul. You know, it's a very competitive industry in EV and autonomous vehicle, and you should really focus on spending billions of dollars in the future, not building a fancy skyscraper at the heart of Seoul. And there are many cases. For instance, some chaebols, you know, they have just a 20% stake in the company. So for the protection of the control, you buy stake in your friends' listed companies, and that company also buys a stake in your company, cross-shareholding, right? So there are a lot of these waste inefficient usage of balance sheets. So there is a clearly misalignment between minority shareholders and the controlling shareholders and the board, you know, who have been handpicked by the chaebol families. They're not really taking any action. So whether from the U.S. experience or any European studies, are there a good examples that we can look at for the Korean families so that there is a better alignment between the controlling families and minority shareholders?
That's a hard question. I wonder whether, well, partly because the last question involved tax. That's the first thing that came to my mind, is if there's a system that's leading to too much cash, if the principal problem is too much cash is sitting inside major Korean companies, I wonder if there's a taxation way to reduce that that cash balance. Second thing on that, which just showed the question I have is, where does the cash go? Is if the cash goes into United States Treasury securities, it's not filtering through the Korean economy. If it's in bank deposits and the banks are lending it out elsewhere in the Korean economy, it's a problem that there's so much cash in the company, but it's not as serious a problem than if the cash is not circulated back into the Korean economy. One aspect is to find, so just that's a preliminary comment. A generality is, it sounds like there are reasons why the families maintain control. Are there impediments to competitors becoming fully public companies? So one way to deal with what you're describing as the Korean problem is more competition in the product market and in the corporate organization market. So one of the questions I would have is there some element of, if we're trying to do this as corporate lawyers or securities lawyers, are there elements of Korean corporate law enforcement or doctrine, securities law enforcement or doctrine, that's impeding these companies from getting fully diffusely owned public companies as competitors? And if there are, maybe that's one of the places to make reform.
Okay, thank you.
Yes, thank you. Thank you, Professor Rowe, and thank you to our distinguished panelists for a very engaging and insightful discussion. I think today's session have significantly deepened our understanding of the concept of short-termism and its implications on corporate governance. And as I conclude today's seminar, I extend our sincere gratitude to Professor Rowe for sharing his deep expertise and perspective. I also look forward to finding out what car you choose to buy between Hyundai and BMW. I suppose you make your decision based on long-term perspective as a consumer. I would also like to thank our distinguished panelists, Professor Ji-Young Chung, Director Hyung-Kyun Kim, Professor Woo-Chan Kim, and Chairman Namu Lee for their engaging questions. And of course, everybody in the audience and whoever is watching this video later on, thank you for joining and viewing this session. If you want to know more about this topic, again, there's an excellent book that Professor Rowe wrote called titled Missing the Target. So that's a book that you can read. We hope seminars like this can continue to enhance the corporate governance landscape, not just in Korea, but throughout the world. So we look forward to welcoming you in the future session. Until then, please take care. Thank you.
Thank you.
Thank you.
Thank you.
Thank you.